My name is Erik Johannesson, and I'm a faculty member at the Department of Accountancy at Borough College, City University of New York. This and other talks in this series about equity valuation is joint work with my good friend and colleague Jim Olson, who's currently a faculty member at Hong Kong Poly U. It draws on 10 years of my own research and, 10 years plus of his. And my objective with this lecture and others in this series is to show how various pieces and aspects of accounting-based valuation fit together. So this lecture is going to be on equity valuation and the role of what we call dividend policy irrelevance. And if you haven't already, I'd suggest you first watch the video titled Valuation, Earnings, Book Values and Dividends. So that lecture provides a good foundation for what I'll be talking about here. And in some sense, this lecture can be viewed as an extension that goes deeper into the details of the dividend policy irrelevancy. So mostly this talk will be conceptual. And I'm not really going to talk about any practical issues regarding dividend policies, what typical policies are or what policies certain investor groups might prefer and why, etc., etc. No, instead, what we want to wrap our heads around is the irrelevance of the dividend policy from a conceptual point of view. And the reason we want to do that is because ultimately, it's a very important concept in order to understand and appreciate the role of earnings in equity valuation. So you can think about the dividend policy irrelevance concept, or DPI, as being the concept that makes earnings the focal point in equity valuation. So when you think about dividends and dividend policies, what you always have to keep in mind is that earnings and dividends will connect and must connect, and this is manifested through the dividend policy irrelevance concept. So for example, when you forecast future earnings, these future earnings depend upon not only current dividends, but also upon current dividends. And such forecasting centers around how things change as you move from one period to the next. So that's sort of what I refer to here as the intertemporal connection between earnings and dividends. That's sort of the conceptual exercise I had in mind here. But just linking earnings and dividends across time is just part of what we're trying to accomplish here. It's a means to an end. And what we're really trying to do is to address perhaps the most central question that you would encounter in equity valuation. Namely, what explains the so-called forward earnings yield? The forward earnings yield would be the expected earnings divided by current price. And just for the record, the forward earnings yield is just the inverse of the forward PE ratio, price to earnings, if that one is more familiar to you. So my assertion is that the forward earnings yield must relate to the growth in expected earnings. In other words, it's sort of common sense and it's easily observed in practice that if you have great growth in expected earnings, then you have to pay for it. So that means that we expect the forward earnings yield to be low. And this is of course just anecdotal, it's anecdotal evidence, but what I'll try to show you in this lecture is that this relationship between the forward earnings yield and expected earnings growth is anything but anecdotal. It has to be the case that these two things connect. And in order to get there, we have to talk about dividends and we have to talk about the dividend policy irrelevance concept. So that's sort of the big picture here on this lecture. All right, moving on. There are some very basic background observations that we have to make. The first one is that when you think about equity value, the foundational idea, or what I call the foundational precept here, is that when you calculate the present value of expected future dividends, you should end up with the equity's value. You can't contradict this basic idea. Of course, you then need to forecast all the dividends from today through infinity. You also need an adequate discount factor or a cost of equity. And so the point is that implementing this scheme may not be trivial. But conceptually, the idea that value equals the present value of expected future dividends must hold true. All of these things here regarding PVED is laid out in every textbook on equity valuation. It's taught in every valuation course. So what I want to emphasize here is that this is just a very basic foundational precept that we take as true. It must be true. We do not want to violate it. But the issue then arises if in fact the stock must be valued per this PVED concept. Then it may seem that the implications should be that you're supposed to forecast dividends, but that's not what's done in practice. And it doesn't make any difference if you take a conceptual or practical perspective. It is not the case that we sit down and we forecast firms' dividend policies, and then we try to connect that with earnings, and then we take the present value of these future dividends. That's not how things are done. So there's sort of an incongruence here in terms of how to value firms, because in practice it really centers around future earnings and future earnings growth. And I indicated on the previous slide that we have to introduce the Dividend Policy Irrelevance concept, DPI, in order to be able to switch the perspective and focus on the forecasting of earnings and earnings growth. This point cannot be emphasized enough. So the question is really how you make the problem concrete. And if forward earnings and earnings growth are driving value, shouldn't there also then be a connection between the forward earnings yield and expected earnings growth? And this is a question that requires an answer. As I said earlier, the issues are quite conceptual, but keep in mind that when everything is said and done, we're actually trying to solve a very practical problem. What explains the forward earnings yield? Or its inverse, the forward price to earnings ratio. That's where we're headed. So we start from the beginning here. And this is pure repetition from the antecedent lecture. The idea of dividend policy irrelevance, it goes back to 1961 in the academic literature. It's often referred to as Modigliani-Miller or simply M&M. And it has long been recognized as being a centerpiece in equity valuation. And the gist of it is that even though the price P is determined by the present value of expected dividends, we don't have to forecast the dividend sequence or the specifics of the dividend policy. And we don't have to worry about whether the policy is going to be generous or whether the payout is high or low. Some companies, they don't even pay dividends. They don't pay dividends at all. And the thing is that at best, the dividend policy is a secondary or tertiary concern, but it's never a primary concern in practice. So DPI allows us to focus on earnings rather than dividends. Now, why would we want to do that? Well, if you look at it from an accounting point of view, dividends or free cash flows from that, for that matter, they don't represent value creation. Dividends represent the distribution of value, whereas earnings represents creation of value. So companies, they engage in business transactions, they buy, sell, manufacture, they provide services, and as they do this, they create value. And that shows up in earnings. That then sets the stage for the distribution of value. And in choosing where to focus our attention, creating or distributing value, obviously the creation of value is far, far more important than the policy that relates to the distribution of value. You cannot distribute value unless you have created value, but you can of course create value without distributing it. So this was a very quick recap, but it sort of helps in providing both a foundation and a background. But what I'm really trying to emphasize here is that these ideas and concepts are really fundamental, both from a conceptual and from a practical point of view. All right, let's look a little bit closer on the DPI concept. The first thing in our setup is a standard definition of PVED, the present value of expected dividends. We have a discount factor, that's lowercase r, and the discount factor is typically something like 8-10% or so. D as in dividends, well, that represents expected dividends. So when we calculate the present value of these dividends using the discount factor r, we end up with a price P, assuming that the price equals PVED. Now, DPI simply means that if you have two sequences of dividends based on two different dividend policies, and you calculate the present value of these dividend sequences, then you must end up with the same value, so long as the dividend policies don't violate certain boundary conditions. So it's not the case that if you're a CFO, a primary concern of yours is how much to pay out in dividends. Sales growth and capital expenditures, for example, they're far, far more important to CFOs than what the dividend policy is. But that's not to say that there aren't certain secondary or tertiary reasons why a CFO might care about the dividend policy. So, for example, we have taxes, asymmetric information, agency issues, etc. And these are all valid issues to care about, but they aren't of primary concerns to a CFO. And just to be sure here, the future is always uncertain. So that means that we have to talk about expected values. But that's sort of implicit. So when I talk about future dividends, I sometimes won't mention the word expected, but it's always implied. All right, the last point here is perhaps the most important one on this slide. How do dividends connect with earnings? This question is going to make its presence felt in later slides. So the dividends must connect with earnings. We cannot have models in which dividends grow at a rate faster than earnings in the long run, because somewhere along the line, dividend growth must connect with earnings growth, and also with the growth in book value of equity. And this means that in the background, we always have one or more of these so-called boundary conditions that I mentioned earlier. But in the short term, of course, and also in the intermediate term, the growth rates in dividends, in earnings, and in book value of equity, they can, of course, differ. But ultimately, the growth rates have to converge to one and the same. So in order to proceed to the question of what explains the forward earnings yield, we now need a benchmark valuation model to model equity value. And we're using the same benchmark model as in the antecedent lecture. We need this benchmark model so that we subsequently can compare it to a more elaborate, expanded valuation model later on. So this model, this benchmark model, it's our starting point, and well, our benchmark model will be used further on, of course. So we start here with a basic precept that price equals PVED. That's the first statement here. The second statement relates to the forecasting of earnings, and it shows the simplest possible earnings dynamic. You can notice that in the absence of dividends, earnings must grow at the discount rate in expectation. So you can think about this as basically being analogous to a savings account. This dynamic explicitly shows something that may seem trivial, but in fact is very, very important for us. Earnings beget more earnings, and the growth rate depends upon the discount factor. If you don't have any dividends, or if you have adjusted for dividends, should they exist. So that's why the first coefficient here, 1 plus r, is very central in the analysis. And of course, it's eminently sensible that when you ask the question, how much is this company going to earn in the future? Well, you just look at the current earnings and then you would say, well, if it weren't for the dividends, on average, in expectation, the company should grow at the discount rate. Then we have the adjustment term C times D, which shows that the extent to which the company distributes dividends is going to have an impact upon subsequent earnings. The more you pay out in dividends, the less earnings will be in the future in expectation. So the parameter C relates to how the company in question does the accounting and how conservative its accounting is. If you have conservative accounting, then C is going to be relatively small. In other words, you can actually pay out dividends, and yes, the dividends will have an impact upon future earnings. But if the accounting is fairly conservative, the effect on future earnings is going to be relatively marginal. The earnings generating process is only marginally influenced due to unrecognized or undervalued assets. So if you have a firm with a quite low book-to-market ratio, indicating conservative accounting, then in general C will also be quite small. It is an oversimplification, but that's basically what you would expect here. Finally, we have a third statement here, which concerns the forward earnings yield. ET+1 here is expected earnings given the current price and other information. And in the denominator, we have the current price. And the benchmark here is that this is equal to the parameter C, a constant. All right. The last thing I'm going to say about C for now at least is that one can note that C really should be less than R in expectation. This was developed more carefully in the antecedent lecture, but it's worth keeping in mind also in this lecture. So these three statements, they comprise a complete model, and this means that any two of the statements imply the third. So if we take PVED as a given, and we believe that the earnings dynamic we have in point 2i is a valid representation of reality, then parameter C is going to be a constant, and it's going to be equal to the forward earnings yield. So that's basically our benchmark model setup that we will be using going forward. Now, the punchline here is the following. This setup ensures that the price P does not depend upon the dividend policy. So even if we change the dividend policy, it won't change the valuation due to the effect that dividends have on future earnings. DPI will hold. And if you look at the bottom of the slide here, there are some additional details and a proof. You can look at it later on with some patience, but for our purposes in this lecture, it's sufficient if you understand the three statements above here. And the focus on this slide is really statement 2i, our benchmark earnings dynamics that allow us to forecast next period earnings based on current earnings and also current dividends. It's a very simple model of how to forecast earnings. It's really the simplest thing possible. But combined with either the first or the third statement, that's going to determine the pricing. Well, let's have a look at a numerical example with the purpose of illustrating that the formal definition of DPI holds. So let's assume that we have a discount rate of 10%. Let's assume that we have the parameter C being equal to 5%. So ultimately then, of course, we should expect to end up with a forward earnings yield of 5%, which is sort of a reasonable number. Plugging these values into the earnings dynamic from the previous slide gives us the expression ET+1 is equal to 1.1 times ET minus 0.05 times DT. And then we have to enter some initial values on ET and DT. And in order to make the points I want to make here, it of course doesn't matter what values you choose. So here let's just assume that ET equals 1 and DT equals 0. So that means that E1 is going to be 1.1. We then need to separate dividend policy, and the first one I've chosen is really the simplest one possible. We make the payout ratio equal to 40%. So DT equals 0.4 times ET. And then we have the second payout policy, and deliberately this one is chosen because it's very weird, almost nonsensical. It's completely arbitrary. So the second payout policy is defined as sin t to the power of 2, where t then is the period's number. So for each period under this policy, we end up with a number between 0 and 1. And this is going to change in a very arbitrary fashion over the years. So now we can start to generate a sequence of earnings and a sequence of dividends. And then we take the present value of these dividends, and for policy 1 we see that the earnings and the dividends, they grow as time progresses. This of course would be expected. The growth in earnings in the absence of dividends is 10%, and if you pay out some dividends, of course you're going to see some reduction from these 10%. But earnings is still always going to be increasing. And then of course, given the payout policy, the dividends are also always going to be increasing. In the last column, you have the present value of each dividend, and then we have the sum of these present values at the bottom. So here, the present value of expected dividends equals 21.96 if we have 350 periods. And now we can, of course, do the very same thing for dividend policy number 2. And we find that, yes, the earnings will go up, but the dividends are much more erratic. So we start out with dividends of 0.78 in year 1. In year 2, we have dividends of 0.97. And then we get down to year 3. Another payout ratio happens to be very small under this weird dividend policy that I've chosen. It's only slightly less than 2%. So that means that we end up with a very small dividend. And as in the previous case, you have the present value of each dividend in the last column. The sum of the present value at the bottom equals 21.99. So we generated 2 very different sequences of dividends, but once you go through the present value calculations, you end up with basically the same number. With the earnings dynamic in our benchmark model, DPI holds. That's the gist here. The dividend policy is indeed irrelevant. That's what we have shown through this numerical example. We always end up with one and the same number, regardless of what the dividend policy is. Of course, the analytics from the previous slide, point 3i, told us that PT equals ET plus 1 divided by C. In other words, next year's expected earnings capitalized by the constant parameter C. In our case, ET plus 1 is 1.1, C is 0.05, which gives you a PT of 22. Just as in the 2 numerical example we just looked at. And what all of this shows you is that the benchmark model does indeed seem to work the way we want it to. The 3 pieces here, price, earnings, and dividends, they comprise a coherent model that exhibits DPI. The model does everything we want it to do because we don't have to worry about the dividend policy. It can be viewed as a zero NPV activity. So the dividend policy irrelevancy is for real in the sense that it's literally true that we do not have to care how dividends are determined in any given period, because when everything is said and done, the dividends must ultimately catch up with earnings. If you distribute a lot of dividends early on, earnings are going to grow much slower, and that means that in the long run, the dividends have to adjust to a slower growth in earnings, and conversely. By contrast, if the payout policy instead were relevant for value, everything would just collapse. And that's what we have avoided by this very simple model. The forecasting in our benchmark model is based solely on current earnings and current dividends. But the thing is, we can always expand the benchmark model and make it more complicated, make the forecasting more complicated. And then we can try to replicate the ideas here and see how that plays out. So the issue as we move forward becomes, how can we generalize this benchmark model? How can we make it incorporate more information without violating the DPI? All right, so now we move on here. And the sophistication is now going to escalate just a little bit. It's not going to be that much more complicated, though. But at this point, it's probably worthwhile to circle back to the motivation behind this lecture and to look at what we're trying to accomplish. So let me repeat this. It goes back to the very first slides. We want to make sure that the dividend policy does not affect the present value of expected dividends. And the reason for this is that our task is to shift our focus to earnings and to earnings growth, since that is the focus of valuation practitioners. Ultimately, we want to be able to explain the forward earnings yield. Forward earnings divided by current price, ET plus 1 divided by PT. And the forward earnings yield should connect directly with expected growth in earnings. And I have a very simple and strong empirical proposition for you. Companies with high expected growth in earnings should have a low forward earnings yield, and conversely. So what I'm saying is that if it looks as if the expected earnings growth for a certain company is abnormally good, above and beyond what the typical growth is in the industry, for example, then when we calculate the present value of all expected dividends, regardless of the dividend policy, we end up with a relatively low forward earnings yield. And we can use our benchmark model as well. We can use it as a benchmark, right? So we can talk about high forward earnings yields and low forward earnings yields relative to the benchmark case. And as we'll see, the concept of abnormal earnings growth will be very relevant for this. All right, so the first statement here is just to highlight that when we expand our benchmark model to include more information in the forecasting process, we do not want to violate DPI. With that said, we can then move on and expand the earnings dynamics. So we use exactly the same starting point as we had before when forecasting ET plus 1. In other words, we have ET and DT with the coefficients 1 plus R and C respectively. But you see, we're adding on something here at the tail end, and we call that VT. And you can think about VT as representing all the information that potentially modifies the forecasting of earnings. It's sort of a composite that picks up on, say, macro information, firm-specific information, and above all, the growth in future sales. It also picks up on the quality of current earnings. So, for example, if current earnings are viewed as being of low quality and overstated, then this aspect will influence VT downwards. So VT influences the forecasting of not only next year's earnings, it also influences the expected earnings 2 years down the line, 3 years down the line, 4 years down the line, etc., etc. In other words, the contemporaneous VT influences the forecasting of several future periods. But the relevance or the effect of VT is assumed to attenuate and converge to zero over time in this setup. And it is hence of interest to look at how long V's relevance or effect persists. So we can think about this parameter A here as being a persistence parameter, to use slightly technical language. If A is close to 1, then the effect of VT persists way into the future. And on the other hand, if A is very close to 0, the persistence is very small and the effect of VT goes away very quickly. Now, to be absolutely sure here, if VT is 0, then we're back to the benchmark model again. The information captured by VT is neither good nor bad, and if A is 0, then the information is irrelevant in the forecasting. We're also back to the benchmark model. So VT here represents something that's observable at day t, unspecified information. And one can actually argue that it is the simplest possible way of expanding on the benchmark model. I don't quite see how this could be done more easily or more simply. Of course, you can make things much more complicated, but here's the thing. It will not add as much as perhaps you would like to think. All right, let's make a few housekeeping remarks here. The future is, of course, always inherently uncertain, so we can put on U+1 here, UT+1, which represents an unpredictable disturbance term or an error term. So now we explicate the uncertainty, meaning that the analysis now must center on expected values explicitly. But it doesn't make much difference for what we're trying to do here. It doesn't really help me to get across the points I want to make. So going forward, we're just going to put UT+1 here to 0. We're going to assume that this is built in. We're not going to use the squiggles, although it may be more correct from an academic point of view. I just wanted to mention these things for completeness and to remind you that it's not as if we're assuming that everything in the future has to be certain. Not at all. The assumption is that the future is completely uncertain in terms of future prices, dividends, and earnings and other things. But we can think in terms of expectations of these variables. And part of the reason we can do that is because we're dealing with fairly simple linear models. Now, without doing any kind of mathematics, what should we expect to happen here? Well, here are my claims. As with a simple benchmark model, in this expanded model, we can use whatever dividend policy we want. And this would, of course, give us sequences of E's, D's, and V's, and then we can calculate the present value of the expected dividends. We will end up with one and the same value, regardless of the dividend policy chosen. So even though this model is somewhat more complicated, it's still going to hold DPI. The next claim concerns what we would expect the effect of V to be and the relation between PT and ET+1 divided by C, capitalized earnings. In the benchmark case, PT equals ET+1 divided by C. So that's a natural point of comparison. And what do we expect to happen here? Well, if V is a positive number, that's sort of good, because that means that we expect growth in future earnings, and we expect that to be good. If V is negative, on the other hand, we have a much more pessimistic scenario. Earnings are not going to grow as much as in the benchmark model. They're going to grow a little less, or perhaps a lot less. So we have two cases. VT is positive or VT is negative. And we should expect a very simple relation here. When V is favorable, PT exceeds the capitalized forward earnings from the benchmark model. The stock will be more expensive, if you will. There will be more PVED to be had, and the stock will be more expensive. So we can think about this as the premium case. And what this implies that if VT is positive, then ET+1 divided by PT is going to be a relatively small number. The unspecified information is going to be favorable, so we have much more growth, a higher PT, and hence a lower forward earnings yield. And then, of course, we have the complementary case, and that's when VT is negative. The logic is exactly the same, But now the effect of PT is, of course, negative, meaning that the forward earnings yield is going to be higher than in the benchmark case. To conclude this slide, what I'm trying to impress upon you is that it's sort of a formalization of how the real world actually works in these simple cases. You'd start out and forecast earnings just using current earnings, possibly with some kind of dividend adjustment. And then you say, well, sometimes things look abnormally good, sometimes things look abnormally bad. And that's, of course, going to affect the pricing. It's also going to affect the forward earnings yield ratio, because the forward earnings yield ratio should pick up on this. And it will. And we're going to see that in some detail. But let's first repeat the numerical exercise that we did for the benchmark model, just to ensure that DPI still holds. In other words, does the expanded earnings dynamic spit out the same PVED regardless of the dividend policy chosen? Just to be sure, we don't expect the same number as in the benchmark model, but we'd very much like to see one and the same number across the two different dividend policies using this expanded model. So we have the same setup as before. The discount rate R is 10%, the parameter C is 5%, and with initial values on ET and DT being 1 and 0 respectively, that means that ET plus 1 equals 1.1, just as in the benchmark numerical exercise. But now you can also note here that we have VT on the right-hand side, and VT also has to be initialized, and I arbitrarily chose to do so by putting VT to 1. And equally arbitrarily, I chose the persistence parameter A to be 0.8, which is a fairly high number. It sort of means that the effect of VT is quite persistent. And if you really wanted to do this in practice, I'd suggest you start with a slightly lower number, say 0.5. All right, we keep the same dividend policies as before, and that of course then gives us two sets of sequences of ED and V. And as before, you have the present value of expected dividends in the rightmost column with the sum of the present values at the bottom. And we can see that for the first dividend policy, the present value of expected dividends is 95.2. And for the second very erratic and nonsensical dividend policy, it's 95.3. So the present value of expected dividends are effectively equivalent, meaning that DPI still holds, also with this expanded earnings dynamic. So to be absolutely sure here, dividend policies 1 and 2 are entirely different. So this dividend sequences, they're of course entirely different as well. And we can see that by just looking at the numbers here. But when everything is said and done, when you calculate the present value of these dividend sequences, you end up with exactly the same number, aside from some minor rounding. So you can note here that PVED from this earnings dynamic is quite a bit higher than what we had for our benchmark model, which was 22. So the setup was exactly the same, except that we now have added this variable V and the persistence parameter A. But V is positive here, and A is quite high. So the effect of V is quite persistent, and we can see that this has a big impact upon the price. 95 is a lot larger than 22. If we capitalize the forward earnings by C, in other words, if we take ET plus 1 divided by C, we get 2.1 divided by 0.05 for both policies, which equals 42. 42 is also quite a bit lower than 95. So the capitalized earnings are less than PVED, just as I claimed on the previous slide. And I can put that differently. If we view the capitalized forward earnings as a so-called valuation anchor, we see that the valuation anchor alone doesn't fully capture PVED once we go beyond the simple benchmark model. We need a complementary term. And this has to do with the positive contribution of the variable V. We can, of course, shuffle around a bit here to arrive at the conclusion that the forward earnings yield ET plus 1 divided by PT is smaller than C. And now perhaps some of you start to connect the dots that if we have earnings growth above and beyond the quote-unquote normal case, as in the benchmark model, this has an impact on the forward earnings yield. It reduces the forward earnings yield because the price is higher. And to be sure, the logic is of course very much the same if we have earnings that grow at a lower rate than the benchmark case. At this point, let's just pause and think back upon what we're doing. We are trying to change our perspective on how to value securities compared to how it's typically being taught in most business schools. So we start from a PVED precept, and then we introduce the Dividend Policy Irrelevance DPI. So that allows us to shift our focus to earnings instead of dividends. And earnings is really what practitioners primarily care about. That's what they forecast. When practitioners value securities as a first cut, they almost always focus on expected earnings, the growth in expected earnings, and the forward earnings yield, or its inverse, the forward PE ratio. And then we expanded our benchmark model, the earnings dynamics, so that future earnings not only depend on current earnings and current dividends, but also on this elusive concept of unspecified other information captured by the composite variable V. And we saw that V has a big impact on the price and the forward earnings yield, causing the forward earnings yield to become abnormally high or abnormally low relative to the benchmark case ET plus 1 divided by C. The last thing I'll talk about on this slide is quite tricky, so pay attention here. I've been talking about the dividend policy irrelevance and its importance, and we have seen numerical examples that show that the concept is indeed valid in a setup like ours. And of course, the dividends are irrelevant for the price. You can choose any policy you want, but here's the thing. The dividends are not irrelevant for earnings growth. The growth in earnings depends upon the dividend. So let me repeat that. The growth in earnings depends upon the dividends, but that's not the growth we care about. The growth in earnings that is solely due to the payout policy is irrelevant for the price, since the dividend policy is irrelevant for the price. So basically, when a company pays dividends, it forgoes future earnings. But you get the dividend instead, and these two effects offset each other perfectly from a PVED point of view. So you either get value in the form of earnings and earnings growth, or you get the value in form of dividends. And this has no effect on the current price. But we just saw in our expanded model here that growth did have an effect on the price, and then by extension also on the forward earnings yield. So how do we reconcile this? Well, even though we don't really care about the growth in earnings that relate to the dividend policy, we do very much care about something that we're going to call abnormal earnings growth. So let's take a look at that. So on the previous slide, we saw that DPI held numerically also for the expanded earnings dynamic. And we also saw that, unlike in the benchmark model, ET plus 1 divided by C does not equal PT if the unspecified value-relevant information variable V is non-zero. So this begs the question, is there an analytical way of deriving PT without going through the motions of specifying the dividend sequence and calculating the present value of these dividends? Of course, as you might suspect, turns out there is. So we didn't really have to go through the motions of mapping out the dividend sequence and taking the present values. So this is the analytical solution here. It has two components. The first one is the starting point, goes back to the benchmark model. ET plus 1 divided by C. Informally, this captures what the price would have been if the earnings growth was not abnormally high or abnormally low. But then you have the second term here. And the second term is an adjustment for the abnormal earnings growth, AEG. And just to be crystal clear here, since PT is a dollar amount and ET plus 1 is a dollar amount, abnormal earnings growth is also a dollar amount. And as we can see, the abnormal earnings growth relates to the variable V that we introduced in the previous slides. So this relates to unspecified value relevant information. This is being capitalized by C just like we capitalized the forward earnings. So capitalized next period V gives you abnormal earnings growth in dollars. And in spirit, it's sort of an add-on to the quote-unquote normal capitalized earnings because you do have abnormal earnings growth in certain cases. As we said, V can be positive, negative, or zero, so AEG can then, of course, also be positive, negative, or zero. But on average, we have no reason to believe that AEG is either negative or positive. So on average, we assume that VT is zero and AEG is zero. And guess what? Then we're back to the benchmark model again. PT equals ET plus 1 divided by C. No adjustment for abnormal earnings growth needed. But the thing is, and this is important, this setup allows us to model cases for which we have reason to believe that V will not be zero and AEG will not be zero. All right. If we shift focus to the denominator, the 1 plus R minus A is just due to a present value calculation. So when everything is said and done, we have our capitalized forward earnings, ET plus 1 divided by C. Then we add the present value of all future abnormal earnings growth expressed in dollars, and then we're done. And there's sort of a sense of, it's an element of common sense to what we're doing. And it does in fact connect with the real world. So before we proceed, let's just check that the formula actually works. In other words, let's just use the same setup as before and make sure that we get the same number, approximately 95.3. Well, in this setup, ET plus 1 is 2.1, C is 5%, VT plus 1 is 0.8, R is 10%, etc. And if you plug these numbers in, you will indeed get 95.3. So I made this point on the previous slide, but it's worth repeating. Given that we have the second term here, and given that in our setup V is positive, the forward earnings yield will be quite small. And it's easy to see that it must be smaller than if we didn't have any abnormal earnings growth at all, as in the benchmark model. And of course, by reshuffling the formula a little bit, we can derive an expression for exactly how much lower the forward earnings yield would be in the presence of abnormal earnings growth. So that's a good exercise that you can try to do yourselves. I'm not going to do it in this lecture. The 2 points on the lower half of the slide basically just summarize what I've been talking about. In this model, we have two components. Our starting point, our valuation anchor, if you will, is ET plus 1 divided by C. If AEG is zero, if we don't have any abnormal earnings growth in the next year, well, the thing is, if we don't have it the next year, it's not going to be forthcoming at all in this model. Without any abnormal earnings growth, the forward earnings yield simply equals C. But if we do have abnormal earnings growth, then we need to consider the second term in the expression here. We need to make an adjustment. And the second term is just going to be the present value of future abnormal earnings growth expressed in dollars. It's an ordinary geometric series, and that's why you have this scaling 1 plus R minus A. It's just like the Gordon-Williams model where you have 1 plus R minus parenthesis 1 plus G end parenthesis, or simply expressed R minus G in the denominator. I know this slide has a lot of information to take in, but the closer you look at these things, the more straightforward they seem, especially if you think about these things sequentially. And that's sort of what I tried to emphasize here, that we start with a benchmark model, and then you can add something that captures abnormal earnings growth. And then that gives you a large chunk of what explains differences in forward earnings yields across companies. It may be high, it may be low, and if you go to AAG to figure out why and if this is warranted, well, then you have your work cut out for you. If V or AAG is positive and persistent, then really the price is going to shoot up and the forward earnings yield is going to go down. And we can elaborate and investigate these things in this expanded model. We continue with the expanded model and the expanded earnings dynamics here, but we recast the expression from the previous slide to arrive at the following formula. It's another way of looking at the expanded model, and it is particularly interesting because of the way in which it underscores the tremendous importance of earnings growth. So, more concretely, if you sit down and do the algebra, you will realize that the expression in the first line can be reformulated such that P, the price P, becomes a weighted average of capitalized ET plus 1 and capitalized ET plus 2. W and 1 minus W, they represent the weights here. And with respect to the capitalized ET plus 2, we have to discount it back one period. That's why we have this 1 plus R term in the denominator. We also have dt plus 1 as part of this expression, but the thing is, in the grand scheme of things, this is going to be a relatively small number. So just think about it. Capitalized forward earnings, with a capitalization factor being something like, say, 6% or so, this would be much, much larger than the dividends. So this in turn means that we can sort of allow ourselves to ignore the dividends. We assume that there is zero here. Then, of course, the equity value can be approximated by a weighted average of capitalized expected earnings 1 year down the line and capitalized expected earnings 2 years down the line. That's what we have derived here. Let me repeat this because it is important. If we allow ourselves to simplify away dt plus 1, then we can think about value as being a weighted average of 2 consecutive and capitalized EPS expectations. And your gut reaction here might be, does this really work? And the answer is that yes, it does actually work. If you estimate values on the basis of this formula and you use a reasonable C, say something like 5, 6, 7%, then you can take the weighted average and then you get pretty close to the trading price. And then you might ask yourselves, okay, but what are the appropriate weights? Well, turns out that the W here equals minus A divided by 1 plus R minus A. So that means that if the persistence parameter A is very small, in other words, if the variable capturing unspecified yet value relevant information, that's our V, if this is very non-persistent, then W is going to be very close to 0. That in turn means that the valuation entirely corresponds to capitalized earnings 2 years down the line, because there are no worries about abnormal earnings growth. I have 3 remarks to make. So the first remark here is, it's just what I said before, basically in slightly more formal terms. The second remark is more interesting to talk about. So setting W to -1 actually works pretty well. In other words, if you sit down with a large data set and you try to estimate W, you're likely to find that W is pretty close to -1. So -1 is a decent shortcut approximation for W. And now for the punchline of this slide. W, the weight on the first term, is negative. W is negative, so minus W is of course going to be a positive number. So the weight on the first term, capitalized next year expected earnings, is negative. And that means that the less you have in next year expected earnings, the greater the price is going to be, everything else equal. And this may sound a bit counterintuitive, but it really isn't if you think about it. You have to keep in mind that we really do care a lot about earnings growth. I think I made that pretty clear. And we saw earlier that earnings growth has a big impact on the price and on the forward earnings yield. If we think about earnings growth as being defined as ET plus 2 divided by ET plus 1, then of course earnings growth is going to go up as ET plus 1 goes down, if we hold ET plus 2 constant. Holding ET plus 2 constant and lowering ET plus 1 would mean that the earnings growth becomes larger and larger and more abnormal relative to the market or industry average earnings growth rate. So that allows me to once again stress that it is not the quote-unquote normal earnings growth that we're really interested in. Earnings growth is affected by the dividend policy in place, as we discussed before. This kind of earnings growth has no effect on the price, according to the DPI. What we're really after here is the abnormal earnings growth, since that does affect the price. All right, lastly, let's very briefly just connect what we have talked about to practice. How would all of this be applied? Well, you can of course ask yourself, for any company, how much better will earnings be 2 years down the line compared to 1 year down the line? And that can then be analyzed in some detail. Do we expect to see growth in sales? Do we expect to see improvements in the profit margin, etc., etc.? And that, of course, then ties into a related question. Is it really the case that if you're looking at a company with fairly large growth in expected sales, do they have a fairly low forward earnings yield? And the answer to that is an ambiguously yes. Conversely, companies with fairly low forward earnings yields, relatively speaking, they tend to have fairly high growth in expected sales. So now we're going to get down to something which hasn't been discussed at all so far, and that's risk. So whenever you think about forward earnings yields in investment analysis, in the background is always the notion that risk should come into play. It's a very simple idea that comes from the bond market, and in our context it sort of means that when the discount factor increases, then you're paying less for future earnings. They become cheaper due to risk. And that means in turn that the forward earnings yield should have a positive relation with the discount factor if we keep the earnings forecasts fixed. And it also means that the forward PE ratio, price to earnings, will have a negative relation with the discount factor. So let's try to tease these things out analytically. All right, let me be crystal clear here. This slide will deal with the forward price to earnings ratio, PT divided by ET plus 1. Up until this point, we have exclusively dealt with the forward earnings yield, which is the inverse. I would have loved to continue with the forward earnings yield, but its partial derivative with respect to R, the discount rate, is much messier. So just keep in mind that what I'll be talking about on this slide is the forward price to earnings ratio here, not the forward earnings yield ratio. Okay, so starting from the expression we had on the previous slide, the weighted average formula, we can normalize both sides with ET plus 1, which then gives us the forward PE ratio on the left-hand side. And then we just have to take the partial derivative with respect to R, and then we get this expression here. The expression shows how much the forward PE ratio changes as the discount rate R changes. So the partial derivative of the forward PE ratio with respect to the discount rate is equal to minus 1 minus W times ET plus 2 divided by ET plus 1 divided by C times 1 plus R to the power of 2. And this is if we allow ourselves to suppress the effect of dt plus 1, just to keep things simple. As I said before, the effect of dividends here is generally quite immaterial. And now we get to the important thing here. And that's that since W is a negative number, we are guaranteed that an increase in the discount rate is going to have a negative effect on the forward PE ratio. So that's pretty intuitive, right? But here's the thing. We can also see that this effect is going to increase as growth increases. Growth amplifies the negative effect of a discount rate increase on the forward PE ratio. Now, if you actually sit down and play around with some reasonable numbers, you'll see that the effect we're talking about here is really not that big, but it is there. And the reason the effect is not that big has much to do with the persistence of abnormal earnings growth, the parameter A we talked about before. So if you have tremendous persistence, then 1 minus W will be a very large number. So the negative effect of a change in the discount rate will be more substantial in such cases. That's sort of the insight from this slide. The forward PE ratio, it decreases as the discount rate increases, which many of you would have guessed intuitively. But here we got a very precise expression for the effect. And furthermore, we see that this effect is amplified by growth and persistence in abnormal earnings growth. All right, here we have some penultimate remarks that I wanted to make before we go to the summary and the takeaways. So the first thing is that we can actually expand the benchmark model even further than we did before. We could have an even more general model. So what we can do is to make the parameter A a matrix rather than a single parameter, in which case the information variable VT must become a vector. So the point is that the model which we end up with and that we have discussed on the last slides, it can actually be generalized even further. That's the point. The second thing is that our setup here centers around the very simple idea that when you think about the very long run, then ultimately the model that we expect to see in the very long run is going to be the benchmark model. We keep coming back to the benchmark model. So the expanded benchmark model with the additional information variable V, it gives us a sense of what's idiosyncratic or abnormal in the near term or in the intermediate term. But ultimately, we don't want to forecast idiosyncratic things way out into the future. So the expanded model mechanically reverts to the benchmark model with time due to this attenuating property of the persistence parameter A. We expect that the idiosyncratic information is going to be zero in the very long run. So that means that we also expect that in the very long run, the forward earnings yield will be normal or average. It will be equal to a constant. It will be equal to C. So that's why ET plus 1 divided by PT can be thought of as a long-run forward earnings yield, or a natural benchmark, if you will. The key thing is that this kind of modeling allows for idiosyncrasies in the near term and in the intermediate term. That's why we expanded the benchmark model in the first place. So when you hear somebody say something like, well, these kinds of companies, they tend to have above average forward earnings yields, or these companies, they tend to have below average forward earnings yields, you know what to do. You have a sense of how to analyze these things. You look at the short or medium term idiosyncrasies that result in abnormal earnings growth. All right, so now we're done. We have covered everything I intended to talk about here, and I'm just going to summarize and highlight a few key takeaways. We have a simple benchmark model, and this simple benchmark model anchored on PVED looks like this. If all equity prices truly followed this model, all we had to do would be to forecast next period earnings and come up with a value of the scalar C, and that would give us the price. Conversely, we could find the forward earnings yield. We would find that this is always one and the same, C. And as we saw numerically, the benchmark model is fully consistent with the dividend policy irrelevance concept, since next period earnings do not depend on future expected dividends. But then we moved on and said, well, what if the world isn't quite this simple? What if there are idiosyncrasies in the near and medium term? In other words, maybe future earnings do not solely depend on current earnings and current dividends. So we introduced the variable V to capture unidentified but value-relevant information. And we also saw that we could introduce some background noise if we wanted to be very explicit about it. That then gave us a new model, an expanded model, and the expanded model has two terms. The first term, the valuation anchor, it captures what the value is without any abnormal earnings growth. The second term then, that's the one that does capture abnormal earnings growth, idiosyncratic circumstances which may be either favorable or unfavorable. The effect on earnings, if any, will have some persistence, and that gives you the second term. And this last expression, it beautifully shows what has always been sort of the thrust of this lecture, that everything is ultimately earnings and abnormal earnings growth. This is what real-world practitioners care about, even if they don't use the same language and nomenclature as I do. This is their mindset. And as we said before, earnings and abnormal earnings growth, they do connect with what is perhaps the most fundamental construct in equity valuation, the forward earnings yield, or its inverse, the forward P ratio. Finally, taking a step back, what is it that we're trying to do here? What are we trying to accomplish from a more broader point of view? Well, we're trying to shift the analysis from dividends and cash flows, value distribution, to earnings, value creation. The creation of value is much more important and much more fundamental in many ways compared to the distribution of value. But that is not to say that ultimately the price today must be entirely consistent with the with the present value of expected future dividends. The dividend policy irrelevance is what allowed us to shift our attention to earnings. To some of you, it may be surprising that we haven't been talking about cash flows, but that comes up later. It's a later stage in the analysis, and it will be handled in a separate lecture. This lecture deals with operating versus financing activities and the quality of earnings. An analysis of cash flows complements the earnings analysis. It allows you to look at the company from a different perspective. And this complementary perspective, it can sharpen the analysis. But the thing is, make no mistake, the focal point in valuation is always earnings and earnings growth. Thank you.